So, welcome back guys. So today we have taken a new chapter which is the working capital management. So in the previous chapters we saw what is the meaning of working capital. So what is the meaning of working capital? It is the excess of current assets over the current liabilities. So we saw a formula also in the tools for financial analysis. There was a part known as ratio analysis. So there we saw the current ratio. What is the current ratio formula? Current asset divided by current liability. So the ideal ratio should be 2:1, which means current asset should be 2 times of your current liability. Then we saw the another ratio which is the quick ratio or acid test ratio. What is this? This is the amount of current liability, total amount of current liability minus the stock. So that is the quick ratio divided by the current liability. So the ideal ratio would be 1:1. So in this particular chapter, we will be understanding how to calculate the working capital. So basically we have cash as part of working capital, trade receivables, payables, stock. So we have these 4 things. So we will be analyzing how to calculate the working capital management based on our daily consumption or daily requirements and everything. So in this basically we have 6 subparts. So first one we will see the introduction to the working capital management. So here we will be seeing the types of working capital, gross, net. So we will be seeing the calculation, how to calculate the working capital based on the stock, cash, etc. And in the second chapter we will be discussing on the receivable management. How do we calculate the receivables? And next, the payable management. In the payable management, we will be ascertaining the amount of payable that should be paid in the current year. And in the inventory management, we will be seeing the economic order quantity or the calculation of EOQ, reorder level, maximum quantity, minimum quantity. We will be seeing some parts of that. And the last one, the management of cash and cash equivalent. So this also form parts of your working capital. So that's the reason we will be discussing on cash and cash equivalent. And lastly, financing of working capital. So now we understood what is working capital and what is the requirement, but we need to know how do we finance the working capital also. No, the amount which is required to fund the working capital, it may be based on overdraft, it may be based on cash credit or short term loans. We will see that, or a commercial paper, commercial instrument, or trade receivable, T-bills or treasury bills. Okay, so now without wasting the further time, we'll start with the introduction to working capital management. So we know what is the background of working capital. So working capital is nothing but excess of current assets over the current liabilities. Understood? The financial management of a business involves management of long-term assets, which means more than 1 year. So working capital will be less than 1 year. Long-term capital and the management of short-term assets and liabilities. So basically in business we have 2 types of assets and liabilities. It may be long-term or short-term based on the duration. If it is more than 1 year, it is long-term, and if it is less than 1 year, it is short-term, ideally. Management of working capital concerns with the management of assets such as cash, marketable securities, which means the maturity period will be normally less than 1 year, receivables, inventory and other current assets, and also liabilities include payables and accruals. So payables means which you have to pay within 1 year. Okay, working capital management is essentially the management of current assets and current liabilities in an organization. Understood? No, working capital is only concerned with current assets and current liabilities. Long term assets and liabilities, it is not concerned. It is concerned with the problems that has been arising in attempting to manage the current assets and current liabilities and interrelationship that exists between them. The role of working capital management is to manage the firm's current assets and current liabilities in such a way that a satisfactory level of working capital is maintained. So maintenance of working capital is very much important, because if there is no working capital, you can't buy the stock. If you don't buy the stock, you can't sell, or you can't pay to your creditors, then you'll go bankrupt. So that is also a problem. You will not be able to gain the market. So if there is high demand and if you are not having working capital, you cannot cater the needs of the customer. So obviously you lose in your customer. So that is the reason working capital is very much important. Theoretical underpinnings. Working capital typically means holding of current asset and short-term assets such as cash, receivable, inventory and marketable securities. So these form part of the current assets. The term working capital, also called gross working capital, refers to the aggregate of current assets. So we have 2 types of working capital. One is gross, one is net. Gross is nothing but you will not deduct the current liabilities. You will be adding up all the current assets. That is known as gross. Net means you will be deducting the current liabilities. That is known as net working capital. Current assets are those assets which can be convertible into cash within a accounting period. So which means stock, receivables you can convert into cash, which means if you sell you will get the cash immediately within 1 year. But what about fixed asset? You will not get it 1 year because you will be using for more than 1 year. Therefore there are cash or mere cash resources of a business concern. However, we can understand the meaning of working capital from the following. Working capital means the funds available for day-to-day operation of an enterprise. So I told you, daily you have to make payments to the creditors, daily you have to make payment to your employees if they are based on wages. So for day-to-day needs you need the funds. That is known as working capital. It also represents the excess of current assets or current liability. So this is what we are learning from the beginning of our financial management, including the short-term loans. Next, working capital is that portion of the firm's current asset which is financed by short-term funds. So here also they are telling the same thing. Working capital is nothing but the firm's current assets. So which means here they are referring it to gross working capital. Okay. From the above definitions, we can say that the working capital is the firm's current assets or excess of current assets over current liabilities. However, the latter meaning will be more useful in most of the times, as in all cases we may not find excess of current assets over current liabilities. So based on the definition, we saw that there are two types of working capital. One is gross, one is net. What is gross? Total of current assets. What is net? Total current assets subtract the current liabilities. So net working capital refers to excess of current asset over current liability, which means net working capital is nothing but current asset minus current liability. Net working capital can alternatively define as part of current asset which are financed with long-term funds. Since current liabilities represent sources of short-term funds, as long as the current asset exceeds the current liabilities, the excess must be financed with a long-term fund. Sometimes working capital also will be financing it through long-term funds. That's what they are referring here. Though both concepts are important for managing it, gross working capital is more helpful to the management in managing each individual current asset for day-to-day operation. But in long run, it is the net working capital that is useful for the purpose. So if you are taking decision on short-term basis, go with the gross working capital. But if it is a long-term decision, please go with the net working capital. When we want to know the sources from which the funds are obtained, it is not working capital that is more important, and it should be given greater emphasis. The definition was given by accountants USA will give a clear view of working capital, which is given below. So the accountants of USA have given their definition. We'll see what is that. Working capital, sometimes called net working capital, is represented by excess of current asset over current liability and identifies the relatively liquid portion of the total enterprise capital, which constitutes a margin of better for maturing obligation within ordinary operation cycle of a business. So what they are telling is that first definition is clear: excess of current assets over current liability. That is clear. That is known as working capital. Okay, and it will show what they are telling. It identifies the liquid portion of the enterprise. Liquid portion means which is readily convertible into cash. Cash or readily convertible into cash. What are those assets? It must be obviously current asset, because fixed asset cannot be converted into cash immediately. But stock, trade receivables, it can be converted into cash in the operating cycle, which means in 1 year. That is what they are telling here, which constitutes a margin of better for maturing obligation. Maturing obligation means we need to repay the amount to the creditors. No? That is what maturing obligation means within the ordinary operation cycle of the business. Each concern has its own limitations and constraints within which it has to decide whether it should give importance to gross or net working capital. So depending upon the requirements, we have to make the definition of working capital. And next, we have the concept of zero working capital. What is this? Zero working capital refers from commonly used working capital, that is current assets minus the current liabilities. So here we will be adding inventory receivable and deduct the payables. Here cash is ignored. That is important. Cash is ignored. So that is zero working capital. So they may ask in the examination, what is zero working capital? Just add inventory, receivables and subtract the payables. The rationale is that inventory and receivables are the major constituents of current assets which affect sales. Further, suppliers finance inventory through accounts payable. So we'll be purchasing on credit and selling on credit. So that receivables and payables come into picture. Inventory, obviously it will be there because we will be stocking the items. Okay, now we'll see the meaning of current assets and current liabilities. So how do we define whether an asset is current asset or not? How do you define an inventory, receivable and cash is a current asset or not? We have a definition for that. So an asset is classified as current asset when it is expected to be realized. Realized means which is expected to be sold or intend to be sold or consumed in the normal operating cycle of a business. So it is a day-to-day activity. The asset should be used or sold. The asset should be sold or intended to be sold or consumed in the normal operating cycle of the business. The asset is held primarily for the purpose of trading. So this asset is not used for any other than trading. It should be used for trading and it is expected to be realized within 12 months. So less than, it is expected to be realized within 1 year. Then only we will be telling it as current asset and it is non-restricted cash or cash equivalent. So it should not be a restricted one. So suppose deposits maturing after 5 years, it cannot form part of the current assets. Generally, current assets of an organization for the purpose of working capital management can be classified into following heads. Inventory. So inventory we have 3. Raw material which is 0% complete. Work in progress which is completed less than 100%. And if it is completed at 100%, it is finished goods. So we have 3 inventories. One is raw material. In this we would have not worked. Work in progress, we would have worked, but it is not 100%, always less than 100%. That is known as work in progress. And the third one is the finished goods, which is 100% complete. Okay. Cash and cash equivalent. Obviously, short-term marketable securities means less than 3 months. So the maturity period should be less than 3 months. And the prepaid expenses. The expenses of next month we have paid today only. That is known as prepaid expenses. Same, so we saw for current asset, now we will see for current liability. So liability is classified as current when it is expected to be settled, which means repaid. So which is expected to be repaid in the normal operating cycle, which means less than 1 year. Okay. The liability is held primarily for the purpose of trading. So if the current asset is also for trading and this also should be purpose of trading only. It is expected to be settled within 12 months. So 12 months or 1 year. Now generally current liabilities of an organization for the purpose of working capital management can be classified into the following. So mainly it is payables or sundry creditors and second one is the outstanding payments, which is the wages and salary. So now planning of working capital. So now we know the meaning of current asset, we know the meaning of current liability and we saw what are the items in the current assets and current liabilities. Now planning of working capital. Working capital of a business should be commensurate with its needs. So if it is a trading one, you need more working capital because you have to maintain a stock. If it is a service sector, the working capital requirement is not much because in service sector we will be not having the stocks and all, only we have to pay the wages. So at the month end if you have the amount, no issues. In between if you don't have, there is no issues because you will not be having such major payments except the salaries at the month end. But in case of a trading concern, we have to have cash on daily basis because you have to top up the stock. Now take an example of a Reliance Fresh or a More or a Tata, Big Bazaar or big organization, DMart. You have to keep the stock on day-to-day basis. If suppose there is a particular item A was completely taken away by single customer. So now you have to refill it because another customer will ask the same thing. But if you are not maintaining it, you will lose the customer. Then they will go to the next shop. Okay. Too high or too low working capital of a business or too extreme of a working capital are equally dangerous. Maintaining too much of working capital is also a problem. Maintaining low working capital is also a problem. are equally dangerous to the existence of the business enterprise itself. High amount of working capital though increases the liquidity position but reduces the profitability, and on the other hand low working capital though increases the profitability reduces its liquidity. So if you are maintaining more working capital, it will reduce the profitability because you would have taken an external loan, for that you have to pay the interest, so profitability will come down. And if you are not maintaining the working capital, liquidity will be a problem because you will not be able to repay the debts on the due dates because you don't have the capital. Now you have to wait for funds again. So such both extreme situations may cause business concern to shut down. So if you are not able to do anything, the final option is shut down. Danger of too high amount of working capital. So what are the problems which are maintaining if you are maintaining high amount of working capital? It results in unnecessary accumulation of inventory. So since you have the more amount, you will purchase more stock and gives chance to inventory mishandling, wastage, pilferage, theft and losses increase. So if you are maintaining more and more of stock, there are too many problems. Mishandling. So employee may mishandle the goods. Wastage. Since inventory is more, they will try to waste the goods. Or pilferage, so there will be theft by the employees, and obviously loss will increase. Excess of working capital means ideal funds which earns no profit for the business. So if you are having more and more of working capital, which means you are not deploying the funds in any useful business. Instead of keeping everything in working capital, you can invest in some other company. You can invest in a T-bill, you can invest in a commercial paper, you can invest in a fixed deposit, you will get interest on that. It shows a defective credit policy of a company, resulting in the higher incidence of bad debts and adversely affects profitability. It results in overall inefficiency. So obviously if you are maintaining more working capital, it will lead to overall inefficiency. So what are the problems if you are maintaining low amount of working capital? So what will be the problems? It becomes difficult to implement operating plans or achieve firm's profit target, because since you are not having working capital, you cannot purchase the stock, you cannot pay the creditors. Obviously there will be chances of default. It stagnates growth and it will become difficult to the firm to undertake profitable ventures for non-availability of working capital funds. It may not be in the position to meet the day-to-day current obligation. I told you, you will not be able to pay the day-to-day sundry creditors and results in operational inefficiencies. The return on investment falls due to underutilization of fixed asset and other capacities of the concern. So business has a capacity to produce 10,000 units per day, but since you are not having working capital, you cannot give the items for its production, you cannot provide the raw materials for the production department. Obviously you are underutilizing your fixed assets capacity. Credit facilities in the market will be lost due to faulty working capital. So if you are not paying to the creditors on time, obviously they will not give you any credit period. They will tell pay us immediate, then only will give you goods, because you don't have that capacity to pay me on due dates. The reputation and the goodwill of the firm will obviously be impaired, because since you will not be able to pay the amounts or due amounts on time, obviously your business reputation will come down. Determinants of working capital. So we know working capital, but what are the determinants in order to find out how much working capital we need? If I'm a manufacturer concern, what are the determinants? If I'm a service sector, what are the determinants? So depending upon size, a sole proprietorship will not require so much of working capital, whereas in case of a limited company and a big company, they require more of working capital. The size and magnitude of the amount of working capital will not be uniform for all organizations. It differs from one type of organization to another type of organization. Depending upon the various conditions and environmental factors of each and every organization, there are many factors that determine the size of working capital. However, there are some factors which are in common of most business concerns. Some are enumerated below. So we will see the factors affecting the working capital. How do we determine that this much working capital is required? First is the nature and size of business. If you are a big concern, you require more working capital. If you are a small concern, you require less working capital. The company's working capital requirements depends on the activities it's carried out and its size also. For instance, public utility organization or a service organization where activities are mere service nature does not require high amount of working capital. I told no, service sector will not require higher amount of working capital because they will be not maintaining the stock. That is the major difference. And they will be requiring amount only for the salary payments. So salary payments will be done normally at the end of the month or at the beginning of the month. At that time they require working capital, not in between. In between they need, but not as much as trading concern or manufacturing concern. As it has no need of maintaining any stock of inventory. In case of trading organization, the magnitude of working capital is high as it requires to maintain certain stocks of goods and also some credit to the debtor. So we have to maintain the stock also, we have to give credit to the debtors, credit period to the debtors. You can't ask them the amount immediately. You have to, they will request us, then give us some time, and we have to maintain that and we have to accept that. Then only we can make more and more of sales. Next, further, if we go to manufacturing organization of the cycle period, the working capital is high because the funds are invested in each and every type of inventory forms of raw material, work in progress, finished goods and also debtors. Industrial units to require a large amount of working capital because the process will be huge. So if you take a car manufacturing company or automobile company, the manufacturing line is very huge. They require from the bolt and nuts till the whole body, the engine, the tires, everything, they require a huge amount of working capital. The second is the production policies. These policies will have a great significance in determining the size of the working capital, where production policies are designed in such a way that uniform production is carried out throughout the accounting period. So concern requires uniform and lesser amount of working capital. Uniform means the production level, if the demand is coming or not, if the supply is less or more, they are not concerned, they will produce same throughout the year. 10,000 units from January to December, throughout the year it will be same. They will not produce excess also, they will not produce less also. Whatever may be the demand, they are not concerned. They will be producing only the uniform or with the 10,000 units in our example. So in that case, the working capital will always be uniform or less. On the other hand, the concerns with production policies according to the needs of the customer will be at peak sometimes and require high amount of working capital. In seasonal industries too, where production policies are laid down tightly in the business season, requires huge amount of working capital. Sometimes there will be a huge customer demand. There will be certain cars, example from Mahindra, from Tata, there will be huge demand for certain cars. They have to produce more and more of cars in order to satisfy the needs. So at that time we require more and more of working capital if we want to satisfy. If you tell that no, we will not produce more, then no problem. But if you are telling that you will be satisfying it, obviously you need to produce more. Process of manufacture. If the manufacture process of a particular industry is longer due to its complex nature, more working capital is required to finance that process. So I told you, if your production process is too big, like an automobile industry or even bigger one, then you require more working capital. You have to fund the specific process. There will be employees at each level. There will be inventory or stock, there will be raw materials, there will be work in progress, there will be also finished goods also, because longer period of manufacture, the larger amount of inventory is tied up in the process and requires higher amount of working capital. So the manufacturing process, if the length of the manufacturing process is more amount of working capital is required. Growth and expansion of business. The business concern at status requires a uniform amount of working capital as against the concern which are growing and expanding. So if you are not expanding or growing, amount of working capital is less. If it is not the case, and if you are going for expansion, merger and acquisition, in those scenarios you will be requiring more working capital. It is a tendency of any business organization to grow further and further till the saturation point. So saturation point means the point at which your sales is fixed, above that you can't go. If any, such growth may be within the existing units by increased activities. Similarly, business concerns will expand their organization by establishing new units. In both the cases, need a working capital requirement increases as the organization increases. Fluctuations in the trade cycle. I told you, demand and supply, there will be a mismatch. Business concern vary according to the general fluctuation in the world. There are 4 stages in the trade cycle which affect the activity. So the telling us there are basically 4 stages. We will see one by one. Accordingly, the working requirements are bound to change. When conditions of boom will prevail. So the first condition is boom. The policy of any prudent management is to pile up a large amount of stock in various forms to take advantage of the lower prices. So now if there is a boom in the market, which means the demand is huge, they will be stocking up the goods. So they will be maintaining heavy stock, they will cater the needs, make a profit. Okay, that fluctuation cause business concern demand of more of working capital. Since we have to maintain more and more of stock, obviously we require more and more of working capital. The other phase of trade cycle, which is depression, which means there is no demand at all. Low or absence of business activities causes the business concern to demand for more working capital. In condition of depression, the products produced are not sold due to the fall in demand, lack of purchasing power of the people. As a result, the entire production obtained was not sold in the market and inventory is piled up. So here we have invested in the inventory, but there is no demand. Obviously, we are at a loser position. Therefore, there arises the need for a heavy amount of working capital. Thus, 2 extreme stages of trade cycles make the business concern to demand more of working capital. In the former case, due to the acts and policies of the management, and in the latter case, due to the natural phenomena of trade cycle. So, in both the situations, we require a huge amount of working capital. But in the first case, it is because of the demand policies of the management, and in the second case, it is the natural phenomena because market is not working. We have the stock, we have the finished goods, but there is no purchasing power of the customer only. Terms and conditions of purchase and sales. So if it is immediate, you require more working capital. If it is even, if they are given some credit period, you can maintain less working capital. A business concern which allows more credit to its customer and buys its supplier for cash, which means we will be giving credit to the customer, but for suppliers we will be paying immediate cash, then obviously we require more working capital. On the other end, the business concern which do not allow more credit to the customer, which means we will be asking the customer to pay immediately, then we require less working capital and seek better credit facilities. For supplies, naturally require lesser amount of working capital. So there are 2 scenarios. One, I will tell you, you are my customer, I will tell you that give me after 45 days, I am okay with it. But for supplier, I will tell, no, I will make payment to you immediately. In this situation, obviously I require more funds because I have to pay him also, but he will give you after some time. But you will give to me after some time. Obviously, I will have to pay him immediately. For that, I need funds. That is one scenario. In the second scenario, I will tell you, I sold the goods, you give me amount immediately. I want it immediately because only cash and carry transactions, there will be no credit facilities. So you give me the amount, I have the amount, but I will tell my supplier that I will not pay you immediately, I will pay you after 40 days or 30 days. In that case, working capital requirement is less because I already have the amount. Next, dividend policy. A consistent dividend policy may affect the size of working capital. When some amount of working capital is financed out of the internal generation of funds, how you will be making profit now? That is also a fund. Now profit is also a savings or fund which can be used in the business. Such effect will be there. The relationship between the dividend policy and the working capital is well established, and very few companies declare dividend without giving due consideration to its effect on cash and their needs. So if you are making dividend also, we need cash because dividend should be paid in cash. You cannot pay in other terms. Normally we have to pay dividend in cash only. So that is the reason there also we need to check dividend policy. If the dividend is to be declared in cash, such outflow reduces the working capital, and therefore most of the business concern declare dividend nowadays in the form of bonus shares. So bonus shares means conversion of reserves and surplus into shares. I will not give you amount, I will increase your share. Instead of giving you dividend, I will give you one share for free. Keep it, because I will be retaining the cash. A shortage of working capital acts as a powerful reason for reducing and skipping the cash dividend. So since I do not have my working capital, I will be telling that I will be skipping dividend, I will be giving you bonus shares. Okay. Price level changes. The changes in price may make the function of a finance manager difficult. The anticipations of future price level changes are necessary to avoid their effect on working capital of the firm. So if we predict that the future prices is going up, obviously we require more and more of working capital. Generally, raising price level require the company to demand more amount of working capital. Obviously, if the price is going up, we have to pay them more. Obviously, we require more funds. And in turn, obviously, the working capital will increase because same level of current assets requires higher amount of working capital due to increased price. The amount of stock is same, but we have to pay extra amount for that. That is why we require more working capital. Next, the operational efficiency. The operational efficiency of a business relates to the optimum utilization of resources. Means we'll be using efficiently, we'll be using effectively, or we'll be using the resources economically. 3 E's: economically, efficiency, effectiveness. Optimum utilization of resources available in the form of factor of production. Say capital, labor, material and machine. So these are the factors of production. If a company is able to effectively operate its cost, its operating cycle is accelerated and requires relatively lesser amount of working capital. On the other, if the firm is not able to utilize the resources properly, will have a slow operating cycle and naturally requires higher amount of working capital. So you have to maintain your operating cycle very effectively. Then only we will be requiring lesser amount of working capital. If you are not maintaining it, there will be obviously a delay, and we have to pay more of expenses, and eventually we require more of working capital. Okay. Percentage of profits and appropriation of out of profits. The capacity of all the firms will not be same in generating the profits. It is natural that some firms enjoy a dominant and monopoly position due to the quality of its product, reputation, goodwill. For example, Colgate toothpaste, Bata chappals, and some other companies will not have such a position due to poor quality and other inherent hazards. So what they are telling here, the capacity of the firm will not be same in generating of the profit, because so Reliance will be earning different kind of profit, ABC Limited will be having different profit, and Adani will be having different profit. So it is natural that some firms enjoy a dominant and monopoly position. Obviously, big concerns will be having dominant position. If not monopoly, they will be dominant in the economy due to the quality of its product, reputation, and goodwill. Obviously, bigger companies, if you see, the reputation is very high. And some companies will not have such position due to poor quality or other inherent hazard. There will be certain small industries, so their reputation is not so good. The company policy of retaining or distribution of profit will also affect the working capital. More appropriation out of profit than distribution of profit necessarily reduce the requirement of working capital. So if you are not declaring the dividend, obviously your working capital requirement will come down, because we will not be paying in the form of cash. Next, the other factors. Apart from the above considerations, there may be some factors responsible for working capital which are inherent to the type of business. Some of the factors may be as follows. So there are certain other factors also. What is that? General coordination and control of the activities of the organization. So this will affect the working capital, because now say 3 departments we have in an organization, A, B, C. Just a second. We have 3 departments. Goods produced from A will be sent to B, and from B to C. So now B requires goods every 2 days. I'll tell that every 2 days I require. A should provide him within 2 days. If it is providing on the 3rd day, there is a production loss for 1 day here, because we don't have the goods. Second day, every second day he has to send. So if you are sending today, you have to not send tomorrow, day after tomorrow you have to send. But this guy didn't send day after tomorrow, delayed by 1 day. So 3rd day sent goods. Obviously there is a delay. Because of this, we need to require more of working capital, because if goods are not received from A, obviously it will go for market, because he has to provide to C. No, C he has to provide every day. So if you are not providing here every day, there will be delay in C also. That is the reason B will go to market. So they'll, instead of buying from a, for that particular day, they'll go to the market and purchase the goods. At that time, we require more of working capital. Understood? There should be a proper coordination and control of the activities in the organization. Absence of specialization of products and their advantages. Then the market facilities. Means of transportation or communication system, because if you are having a good means of transportation or communication system, the requirement is less, because see, now the distance between one factory and another factory is 400 kilometers, and usually the goods are transported through air transport. The timing is less, obviously it will reach fast, but due to the weather conditions, the flight could not take off. Obviously now it should come to train or a lorry. The time, there is a more time taken by them. Because of that, you have to pay them more. Obviously, the means of transportation will increase the working capital requirements. Sector in which the firms work, private or public sector, and government policy as regards to imports and exports. Tax consideration. Sometimes we have to make the tax payment, which is the GST in India. Availability of labor and its organization and area which it is situated, backward or sub-rural, rural or suburban. In that regions, we have to make lesser payment of wages. But if you are in a correct urban cities like Mumbai, Delhi, Kolkata, Chennai, Bangalore and all, you have to make higher payments to the employees. Okay, these are the factors or determinants which affect the working capital. Now we will see the types of working capital on the basis of nature. So earlier we saw the types of working capital based on what? It was gross and net. Now here we are seeing based on the nature. There are two types of working capital, in the distinction of which it is made keeping in view of the nature of such funds in the business concern. So first is the fixed, regular or permanent working capital. So permanent working capital is that the amount will be fixed every month. Salaries, rent, the amount which should be paid to salaries and rent is fixed every month. You can't change it unless there is a increase in that. It is fixed. We require this much amount every month. Maintaining stock every month we have to require. But there are certain variable or seasonal or temporary or flexible working capital, which means it will occur once in 2 months, once in 3 months, and some it may occur we will not know in advance. So there are which will not recur every month. So that is known as variable, seasonal, temporary or the flexible working capital. Every business concern has to maintain certain minimum amount of current assets at all times to carry on its activities efficiently and effectively. It is indispensable for any business concern to keep some material as stock, some in the shape of work in progress, and some in the form of finished goods. So we have to maintain all types of stock. It may be raw material, work in progress, or finished goods. It can be anything. You have to maintain all the three types of stocks. Similarly, it has to maintain certain amount of cash, because we have to make payment to creditors, we have to make payment to wages. So there will be certain day-to-day expenses which should be paid in cash. We can't take credit out of them. We cannot ask them credit period to meet its day-to-day requirements. Without such minimum amount, it cannot sustain or carry on its activity. Therefore, some amount of working capital, which is current asset, is permanent in the business without fluctuation, like fixed asset, or such amount is called working capital. So what they are telling here, without such minimum amount, it cannot sustain or carry on its activities. Obviously, working capital is required to sustain in the business in short run. Therefore, some amount of working capital, that is current asset, is permanent in business without any fluctuation. Correct? Like fixed asset, and such amount is called working capital, which is the permanent working capital. Not only working capital, it is permanent, because we have to maintain this at every point of time. To say precisely, permanent working capital is irreducible minimum amount of working capital. So you cannot go below this level, because we have to make payments every day, necessary to keep on its activities without any interruptions. It is that minimum amount necessary to outlay in the fixed asset effectively. On the other hand, temporary working capital is the amount of current assets which is not permanent and fluctuating from time to time. So Permanent is means it will not fluctuate, and here it is fluctuating because the requirements may go up or go down based on the market conditions depending on the company's requirement, and generally it is financed out of short-term funds. So this non-permanent or temporary working capital is always financed out of short-term funds. It may also be high due to seasonal character of an industry, such as seasonal working capital. So sometimes if you see, if you know the juice center, in summer seasons they require more and more of juice because since the temperature is high, people will be buying more. In case of a rainy season, in case of a winter season, you have to maintain minimum stock, but the requirement will not fluctuate like how it was in summer. If in summer, if you see, the temperature will be fluctuating. If a particular day the temperature is high, the number of glasses sold will be more because the temperature was high. You have to cater that demand. There is an unexpected increase which you didn't expect the previous day. Okay, that is temporary, but fixed capital you have to maintain the stock throughout the year. You cannot keep your you cannot keep your shop empty. You have to keep something in the rack. You have to keep some fruits, apple, orange, or something like that, butterfruit, something you have to maintain in the shelf. You cannot keep the shop empty. That is known as fixed working capital. But in case of summer season, if the demand is high, you have to purchase more and more of goods or more and more of fruits. Okay, see, if you see this line graph, see this is fixed because that is the reason it is a straight line, because you have to maintain this at every point of time in the year. But in the temporary or variable working capital, see, the graph is going up, down, again going up and down, and it went to the peak and again it come to the bottom. That's what I told. So this will be fluctuating. So this will be fluctuating, and this is always fixed. Okay. Now we'll see the working capital cycle. So working capital cycle or operating cycle, what is this? Are synonymous terms in context of managing the working capital. Any business concern, whether it is a financial nature, trade organization or manufacturing organization, needs certain time to net fruits of the effect. So it will require, you will not be getting immediately the return. You have to maintain, or you have to wait for certain period of time. That is by investment of cash or producing or doing something for some time to fetch profit. But soon after the investment of cash, it cannot get that profit by way of cash again immediately. It takes time to do so. So now if you invest something in the business, you will not get the return immediately. You have to wait for a certain period of time. The time required to take from investment of cash in some assets and conversion of it again into cash, termed as working capital or operating cycle. So what is working capital here? The time required. So I highlight it in a different color. See, the time required to take from investment of cash in some assets and the conversion of it again into cash. So investment of cash in the form of assets and taking it back in the form of cash is termed as operating or working capital cycle. Okay, hence the cycle refers to a time period. The following figure shown, see, if it is a manufacturing concern, first I have the cash, I will buy the raw materials, then this is 0% complete, which means I didn't work anything. Now I'll hire employees, pay them salary, I'll have some direct expenses and make them work on it. So obviously the next step will be work in progress, which is less than 100%. They have worked on this, but it is not 100% complete. So which is known as work in progress. And once work in progress is completed at 100%, it will become finished goods. So finished goods is a 100% completed good. Okay. Then what you will do with the finished goods? You can't keep it for yourself. You have to obviously sell it in the market. So it may be in the form of cash sales or it may be in the form of credit sales. Obviously you have to sell it. So sometimes you will be, if you are selling in on cash, directly you will be receiving the cash. Okay. If you are selling it on credit, So you'll be maintaining debtors or bills receivable, and once it is matured, you'll get the cash. So this is the operating cycle of a manufacturing concern. First, I'll buy the stock. I'll work on it. Then it will become WIP, which is not 100% complete. And when it is completed, it will become finished goods. Finished goods, I can't keep it for myself. I have to sell it in the open market. What I'll do? I'll go to the open market, sell it. What is that? Next step is sales. I have made the sales. Sales can be two types. One is cash, one is credit. If it is a cash sale, you'll get the cash immediately. You'll get the cash immediately if you're selling it on cash. And if you're selling on credit, there will be one party coming in between, that is debtors or bills receivable. So it will be for certain period of time, 30 days, 45 days, bills or debtors will be there, and after the maturity period you will receive cash from the debtors. Okay, this is the operating cycle of a manufacturing concern. Next, we have the operating cycle of trading concern. Here we will not be producing. We have the stock, sell it, we get the cash. If it is a cash sale, we will get directly cash. If it is on credit, there will be debtors in between. In a trading concern, operating cycle will be cash, stock, debtors and cash. So you have the cash, purchase the stock, sell it, it will be debtors, or sometimes it will be directly cash in case of a trading organization. So in case of financial terms, the operating cycle will be cash, debtor and cash only. See, I have the cash, I'll give you amount, you'll be giving back me the amount along with the interest if it is a loan. If I accept a deposit from you, I'll accept the cash, I will be paying you dividend. So there will be only two parties, debtors and cash. Okay, this they may ask in exam. Okay, so please be aware, manufacturing, trading and financial organization. So now we will discuss, see, the operating cycle of a manufacturing company involves three phases. First, acquisition of resources, stock, raw material, such as raw material, labor, power and fuel, etc. First we will be acquiring, which is the raw materials part. Second, manufacture of the product, which includes conversion of raw material into work in progress or finished goods. So if you are completing 100% in that financial year only, directly go to finished goods. If you are not completed 100%, it will be booked in the work in progress. And the third part is sale of the product, either for cash or credit. It can be, sales can be based on cash also, based on credit also. If it is cash, immediately you will receive the cash. If it is on credit, there will be certain time gap between the receipt of cash, maybe 30 days, 45 days, depending upon the credit policy. Credit, sales, credit, accounts receivable for collections. The length of the operating cycle of a manufacturing firm is the sum total of. So what is the length of the operating cycle? First we have to add the inventory conversion period. Second, you have to add the debtors conversion period. So in inventory we have three: raw material, finished goods, work in progress. Add the three, then the debtors conversion period. So conversion period means from in how many days it will be converted into cash. Okay, the inventory conversion period is the time needed for producing and selling the product. So that's what I told. How many days it will take for producing and how many days it will be taking for selling the goods. Typically, it includes raw material conversion period, I told now, work in progress conversion period and finished goods conversion period. So stock has three types. The debtor conversion period is the time required to collect the outstanding amount from the customer. So you'll be having outstanding amount now, which should be received from our customers. The time required to collect from the customers, how many days it has taken. The total of inventory conversion period and debtors conversion period is referred to as gross operating cycle. So if we want to calculate the length of the operating cycle, it is nothing but inventory conversion period and the debtors conversion period. If you add these both, you will get the gross operating cycle. So in inventory conversion, we have to think three: raw material, finished goods and the work in progress. Okay, so that is what they are telling here. So now we will be discussing some of the formulae. So the first one was gross operating cycle. So we will write it down. So working capital formula. The first one was gross operating cycle. So what was the formula? Inventory conversion period plus debtors conversion period. Okay, inventory conversion period plus the debtors conversion period, that is the gross operating cycle. So in inventory you have to add 3: raw material, work in progress and the finished goods. Okay, the second one was net operating cycle. So we saw the gross, now we have to see the net operating cycle also, no? So what is the formula they are telling? It is the difference between the gross operating cycle and payables deferral period. So net operating cycle is the gross operating cycle. So gross operating cycle we would have calculated in the previous formula. Subtract the creditors deferral period. So we have to see the creditors deferral period. So we have to discuss on the creditors deferral period thing. Okay. So net operating cycle is also referred to as cash conversion cycle. So please be important. You have to mark this. It is important. They may ask in examination what is cash conversion cycle. You have to define what is the net operating cycle. Next, see in the inventory, as I told you have to add 3 things: raw material conversion, work in progress and the finished goods. So first, the heading is inventory conversion period. In that I have the first one, raw materials conversion period. So what is this conversion? Actually what are we calculating here is that how many days it will take to convert or how many days it will take to consume. So raw materials it has to consume. So in how many days the raw materials will be completely exhausted. That is what we have to find out here. See, raw material conversion period is the average time period taken to convert the materials into work in progress, which means I have the raw materials and it should be, the next step is conversion into work in progress. In how many days the raw material is converted into work in progress? That is what I have to find it here. But how do I know? Simple. I have the amount of raw materials. This I have 100 units of raw materials. Per day, 10 units is consumed. Understood? Understanding my concept now? I am telling I have 100 in my stock. I have 100 in my warehouse. In warehouse I have 100 units of it. Per day, the production team is using 10 units. In how many days this warehouse is empty? Obviously 10 days. Per day 10 means in 10 days they will be using all the raw materials in the godown. So now raw materials is 0. Now it should be either WIP or the finished goods. If it is less than 100% completion, it is work in progress, and if it is 100% complete, it is finished goods. Understood? Simple. So the formula goes like this: raw material which is in stock by daily consumption. So how much it will consume per day. So that is what they have found. If you see the formula here, raw material consumption divided by 360. Here what they are doing, total consumption divided by number of days. But what I will do, take daily consumption. How many days? In how many days the stock will be empty. So that is what raw material consumption period. Second one, we have the work in progress conversion. Work in progress conversion. Okay, what is work in progress conversion period? So here, what is the formula? Work in progress inventory, which is not complete at 100%, divided by daily cost of production. So here what are we doing? In the raw material, we found out that in how many days raw materials will be converted into work in progress. And here what we will see is that, see the definition. Work in progress conversion period is the average time taken. So I will highlight it out. Average time taken to complete the semi-finished goods, which means it is not completed 100%, it is less than 100%, are work in progress. So in how many days the work in progress will be converted into finished goods? That is what they are telling here. So from in earlier it was raw material to WIP, and here it is WIP to finished goods. Understood? So the formula is work in progress inventory. Where do we get this? Work in progress inventory will be given the question, divided by the cost of production. Okay, cost of production, direct material, direct labor, direct expense. Add it, you will get the cost of production. And third one, we have the finished goods. Finished goods conversion period. So what is finished goods conversion period? It is the average time taken to sell the finished goods. So it is the time taken to sell the finished goods. So the formula is finished goods inventory. So you will be having finished goods inventory in the warehouse divided by the daily cost of production. In how many days the finished goods will be sold? Okay. So completed. So in the first one, the gross operating cycle, add inventory conversion period plus debtor conversion period. So now we have calculated inventory. So what is that? Raw material, work in progress and finished goods. What is raw material? Raw material inventory divided by the daily consumption. What is work in progress? Work in progress inventory divided by the cost of production. And in case of finished goods, which is finished goods inventory divided by the cost of production. Okay. Now what is left? Debtors conversion period. So what is debtor conversion period? Debtor conversion period is the average time taken to convert debtors into cash. So it is the time taken to convert debtors into cash. So what is the amount in debtors divided by the cash? So what is the formula? Again it goes with the same formula, which is finished goods by cost of production. No, this is wrong actually. It should not be like that, no? So this is the wrong formula. Actually the current formula is given here, see. So I'll take it as part 2, debtors conversion period. So the receivables divided by the daily collection, which means how much you are collecting daily. Okay, that is the time taken to convert it into cash. So how much you will collect daily. Next, creditors deferral period. Obviously creditors deferral period, obviously payables divided by daily payments. So in how many days creditors will be paid. Okay, so now we have saw the conversion period. Now we will see the estimation, how much amount of working capital we have to maintain on a daily basis. That also we should see now. Estimation of working capital. In order to calculate the working capital needs, holding period of various types of inventory, collection period, credit collection period, credit payment period are required. Working capital, we have to check the holding period of inventory, how much amount of inventory will be there, and what is the credit period given to our debtors, and what is the payment term in case of a creditor. Working capital also depends on budgeted level of inventory in terms of production or sale. The calculation of working capital is based on the assumption that production or sales is carried out on evenly throughout the year and all cost accrue similarly, which means they are not taking here the fluctuations, only they are taking that all the sales, all the production will be even or same throughout the year. There is no ups and downs in the production or sales during the year. So this is the assumption we are making. So in order to find out how much working capital, we have to check what is the formula. Current asset minus current liability is the working capital. So what are the current assets? Inventory. In inventory we have 3: raw material, work in progress, finished goods, debtors, cash, prepaid expenses, and subtract the payables and outstanding expenses. Okay, So the first formula is the estimation of current assets. Estimation of working capital. So for that we need current assets. Current asset minus current liability. So the first one is current asset. In that I'll take inventory. So in inventory I have the first one as raw material. So how much raw material I need? So raw material is based on production. So I'll take budgeted production into cost per unit. So I'm determining in terms of amount, okay, not in terms of units or not in terms of units, in terms of amount. So budgeted production into cost per unit. So this is the raw material cost into holding period by 360 or 12 months. So if the holding period is given in days, take 360. If the holding period is given in months, take it as 12 months. So this is the formula to estimate the raw material requirement. Next, work in progress. So what is the formula for work in progress? The relevant cost to determine the working capital inventory are proportionate share of the cost of raw material and conversion cost such as labor and manufacturing overhead. So here we have to take the cost of production. So here also the formula is same. What is that? Budgeted production, how much we are planning to produce, into cost of WIP. So cost of WIP will be obviously cost of production into holding period divided by 360 or 12 months. Okay, please write it down. So we saw the raw material, we saw the work in progress. Next we will see the finished goods. So estimated work in progress cost. So obviously work in progress cost will include three things: direct material, direct labor and the direct expenses. So obviously it will be cost of production only normally. Finished goods. Working capital is required to finance the finished goods. So we have to maintain the finished goods also. No? In the showrooms we have to have the finished goods. So the formula is budgeted production into, here also it will be cost of producing the goods or cost of production into holding period. Holding period here means, so why are we multiplying with holding period? Because you have to hold certain materials for certain period of time, then only it will be refilled. So now I have a holding period of 10 days, means I will be maintaining finished foods for 10 days. After 10 days I have to go to ask the production to send me more. So so I have a showroom that normally the stock will be cleared within 10 days. Example I am taking. After 10 days I have to ask the warehouse guys to please refill our showroom because the goods are empty. Okay. And also I told no assumption, the production is uneven, which means I'm assuming that I'll sell one good in a day. So obviously in 10 days I'll sell 10 days. Now if the demand is fluctuating, which means in one day I sell it 3, in one second I'll not sell anything, in the third day I will sell 4. So in that situation this formula will not hold good. Okay. Finished goods. Understood? And next we saw the debtors. So the second current asset is debtors. So what is the formula? The working capital included in the debtors should be estimated in relation to the total cost price excluding the depreciation. Here we have to take cost of sales per unit but excluding depreciation. So here it will be budgeted production into total cost excluding depreciation into average collection period. So debtors, we have to take collection period divided by 12 months or the 360 days. Okay, understood? So this is the debtors. Cash and bank balance. Obviously, they are telling the question that company wants to estimate that it should have minimum amount of, I want this much amount of working capital, this much amount of cash should be in my bank balance or cash in hand. Apart from working capital needs for financing the inventory and debtors, firms also find it useful to have some minimum cash balances with them. It is difficult to lay down the exact procedure of determining such an amount. This would primarily be based on the motives for holding cash balances of businesses, firms, and attitude of the management toward risk, access of borrowing sources in times to need, and past experience, so on. So cash and bank balance will be depending on various things. So whether I can get the amount immediately from a party, that I will check, whether there is need. So all the factors I will take into consideration. Now the estimation of current liabilities. So what is the first one? Trade creditors. So trade creditors means obviously raw material cost, because how much amount I should pay for the creditors? Obviously the raw material cost. I will not pay anything above that. So budgeted production into raw material cost into credit period allowed divided by 12 months or 360 days. Okay. Next, direct wages or overhead. So here we can make two formulas, or one. I will make two only instead of one. It will be easy to understand. So direct wages means budgeted production into cost per unit. So which means raw materials or direct wages paid per unit. So see, direct labor paid per unit. So I also put like that only. Direct labor per unit into lag in payment. So sometimes you will not be paying immediately, there will be lag. So that's what we will be taking for consideration of estimating the working capital. So there will be lag in payment after 15 days, after 1 month, after that only we will pay. Okay. So for overheads, it will be budgeted production into overhead per unit into lag in payment. If it is there, lag in payment minus, divided by 12 months or 360 days. So this 360 days, 365 days, it will be given in the question. So if it is not given, take 360. If it is given, take the number of days which is given. So month, obviously you have to take 12 months. If it is weeks, take denominator as 52 weeks. Okay, please be careful, 52 weeks. Okay. So we have covered trade creditors, wages and overheads, and now we have GST. So GST is simple. GST is budgeted production into GST per unit. Okay, and average lag time, I guess. Average, yes. So obviously we will be paying GST following the month, no? So if you have made sales in April, you will be if you have made sales in April, you will be making payment on May 20th, normally in India. So in India, we will be making payment which should be paid by 20th. So time lag in payment. So time lag they will be given in question, okay? Obviously 12 months or 360 days. Okay, this is the GST. So this is the formula to calculate the amounts. How much amount of, so if you see from the beginning, so where is it? Conversion period. Okay, conversion period understood. See, first inventory, how much amount of raw material you require, total budgeted production into raw material cost. This is the raw material cost I must be maintaining in the form of working capital. Into the holding period, how much amount I'll be holding divided by 360 days. So this will be helping me to calculate the working capital for raw material, work in progress and finished goods. So then the debtors, what is the collection period? So average how much days it will take in an year to calculate the debtors. Then subtract the trade creditors, wages, overheads and GST. In how many days you have to make payment to trade creditors, direct wages, overheads and the GST. Okay, please copy down. So I'll write a note, okay, for the denominator. So if it is days, take 360 days. So I am telling all this if it is not given in the question. So assumption is that if it is not given in the question. So days, if it is weeks, take 52 weeks. If it is months, obviously I have to take 12 months. Okay. So now, so we have calculated all the cost or all the total requirements of the working capital. So we have estimated what is our inventory. So inventory, it may be it may be raw material, work in progress, or the finished goods. So we have estimated all the cost of the inventory. And next we have estimated what should be our debtors. What is the amount that is blocked in the debtors, and what is the amount of cash balance. So what is the amount of cash balance we have to maintain in our bank or cash in hand. So we have estimated the requirement of cash and bank, debtors, and the inventory, and how much we have to make payment to the creditors, direct wages, overheads, and the GST also. So the net of it will be the working capital requirement. So the main underlying assumption is that the production, the sale, everything will be even throughout the year. So there will be no changes. So there will be no changes means there will be no fluctuation in between. Okay. So once you calculate all the amounts as per the formula, and you have to put it in this format. So first is the minimum desired sales or bank balance, which will be given in the question. So minimum desired of cash and bank balance. So then inventory, we have raw material, work in progress, finished goods. So this we will be calculating using the above formula, and the debtors. So you'll add it up, you'll get the current assets. Then you'll be deducting all the current liabilities. So creditors we know, wages we know, overhead, and the GST. So this is the total of current liability. So if you deduct A minus B, you will get the net working capital. So this is the amount of working capital it should be maintained. Sometimes there will be a contingency, as I told, this is taken on even sales, even production, but we may have some contingency because of it we will be adding a margin. So margin for contingency, which means some percentage of net working capital will be adding it. So that is the margin for contingency, and the answer would be the amount of working capital required. Okay. So it is C plus margin. So net working capital plus margin, it will be the total amount of working capital required. So on the basis of this we have illustrations. Okay. So that will be solved. So now we'll quickly revise what we have learnt in today's session. So first is that we started with the introduction to working capital management. So we saw what is the meaning of working capital. So what is the meaning of working capital? It is excess of current assets over current liability. So we have two things: current asset, current liability. So we saw what are the theoretical underpinnings, which means the definition of working capital. So various persons have given their own definition, but what we understood is that what is working capital, it has two definitions. One is excess of current asset over current liability, and the second one is it is the amount which we should maintain on day-to-day operation. And the second is that there are two types of working capital, which is gross working capital and the net working capital. Gross is nothing but total of current assets, that is known as gross, and in case of a net working capital, it is total of current assets minus the current liability. Then the concept of zero working capital, here we will not be adding the cash and cash equivalent, just we will be adding inventory, receivables, subtract the payables. So we saw the definition of current asset, current liability. What are the major understanding which we took? It is that it should be less than 12 months, it should be used for trading, and it is in a normal operating cycle. Okay, so what are the examples of current assets? Inventory, receivable, cash and cash equivalent, and the prepaid expenses. Current liabilities, which is expected to be for trading, less than 12 months, normal operating cycle. Then what are the examples? Payables and outstandings. So next, planning of working capital. Here we have to not maintain high working capital also, you have to not maintain low working capital also. It should be in between these two based on the requirement. So what are the determinants or nature? What are the factors affecting the working capital? We have to plan, but based on what factors? First is the nature and size. So depending upon the size and nature of business, you have to take. If it is a manufacturing concern, more working capital. If it is a service sector, less working capital. If the size is big, more working capital. If it is the size is less working capital. Then the production policies. If the production process is long, more working capital. If it is less. Same in case of manufacturing. If we want to go for growth and business model, you have to require more working capital because you will be having more payments. And the fluctuations, I told you, demand. If there is more demand, we have to take. So we saw two situations, depression and boom. Both the cases we require more working capital because we have to fill up the stocks. Then the price level changes. Obviously, we have to pay the same price for the. We have to pay more for the same amount of goods. Then the types of working capital, which means fixed, permanent and flexible. So permanent is that part of working capital we have to require every month, and in case of a temporary, it will be fluctuating. So then we saw the working capital cycle for manufacturing, trading and the financing firms. So from cash it will be converted to raw material, finished, WIP, finished goods, sale, cash or debtors, depending upon the type of sale. So that we discussed. And next, we saw the conversion period, how to calculate the conversion period for inventory and debtors. So inventory we have three: raw material, work in progress and finished goods. So then we started with the estimation of working capital requirements. So how do we estimate? So we saw for raw material, work in progress, finished goods, debtors. In case of current assets, so cash and bank balance, it will be given in the question based on the company's requirement and the current liabilities. So trade creditors, direct wages, overheads and the GST. Then we saw the format, how it should be done. So in the next session, we'll start with the problems with relation to the estimation of working capital. So today we'll be winding up the session now. So we have discussed every formula. In the next session, we'll be taking up the problems. So we'll end the session. Thank you for your time, guys. Bye.